They just pulled the oldest trick in the book, and they're hoping we don't notice. Here's what happened. After silver ripped higher in 2025, the Wall Street machine started pushing a back to normal story for 2026. They're floating one cute little number, 5.9% a year, like that's the natural law of silver, like last year was a fluke, like the breakout already spent itself. And if we swallow that, we hand them our position right before the squeeze tightens. Now watch this. They're using 50 years of history like it's a seatbelt, but it's not a seatbelt. It's a blindfold. They're averaging decades where silver was chained down by rule changes, paper dumps, and emergency interventions. They're blending normal years with engineered crashes, then handing us the smoothie and calling it analysis. Fact. The story being pushed is that silver's 2025 move was exceptional, and returns should revert toward a low single-digit average in 2026. Meaning, that message isn't designed to help us, it's designed to calm us. Because calm people sell. Calm people stop stacking. Calm people look away while institutions do the opposite. And we know this pattern. When a market breaks a long ceiling, the crowd gets a headline. The insiders get inventory. So let's strip this down like we're in the same room, looking at the same chart, hearing the same spin, and deciding what we do next. First, that 5.9% number. Averages are fine when the system is stable, but silver doesn't live in a stable system. Silver lives in a casino wearing a lab coat. The average return includes periods where the rules changed mid-hand. It includes rallies that were snapped by margin hikes and paper floods. It includes years when industrial demand was smaller, when solar wasn't eating the metal, when EV supply chains weren't fighting over every gram. Using that average to forecast 2026 is like using the average speed of a car that sat in traffic for decades to predict how fast it'll go once the road finally opens. Different road, different engine, different stakes. Now here's the part that exposes the whole thing. The same narrative pipeline that tells us expect modest gains also admits something big changed at the start of 2026. China tightened exports. Fact. The claim circulating is that as of January 1st, 2026, China restricted silver exports to protect domestic industry. Meaning, love it or hate it, it signals one thing. Silver isn't being treated like a cute, precious metal anymore. It's being treated like a strategic input, a choke point, a lever. And when a country starts treating a metal like leverage, the market doesn't get 5.9%. The market gets friction. The market gets stress. The market gets higher bids from people who don't have a choice. Because industrial buyers aren't investors. They're prisoners of the periodic table. If a manufacturer needs silver to keep production lines alive, they don't care about your historical compound annual return. They care about delivery. They care about continuity. They care about not shutting down a factory because a component went missing. So here's the real question we should be asking each other. If supply tightens even a little and demand keeps rising, who is selling them the metal? Us. That's why the narrative has teeth. It's not random. It's not innocent. It's persuasion aimed at one outcome. Get retail to loosen its grip. And they're using fear as the hammer. They're waving past crashes like a horror trailer. Silver has plunged 70% to 90% after big rallies. They want that line stuck in our throat every time price dips a few dollars. They want us to feel motion sickness. Fact. Silver has seen violent drawdowns after major spikes in prior cycles, meaning those drawdowns were not simply the market being the market. Many were linked to leverage unwinds and rule shifts that hit paper traders the hardest, especially when the wrong side of the trade was crowded. And today, our setup is not a carbon copy of those periods, because the silver market now sits under a different kind of pressure, structural industrial demand. Let's keep it simple. Silver isn't just a shiny thing we tuck away. It's an ingredient. It's in panels, contacts, medical, electronics, everything that moves electrons with low loss. And unlike gold, a lot of silver gets consumed in tiny doses across billions of products and then disappears into drawers, landfills, and dead devices. That matters because it means a chunk of demand is destructive. It doesn't come back on schedule. So when they tell us, relax, mean reversion, modest returns, we need to look at what's actually chewing through supply. Solar is the obvious one. Fact. Projections being cited put solar's silver consumption in 2026 at well over 100 million ounces, with some estimates clustering around 150 million ounces. Meaning, when one industry starts taking a meaningful slice of global supply by itself, price stops behaving like a sleepy average. Price behaves like rationing. Rationing doesn't feel polite. It feels violent. It feels like bidding wars. It feels like pay up or shut down. And solar is only one mouth at the table. Electronics keep scaling. Grid upgrades keep scaling. Data centers keep scaling. EVs keep scaling. Even efficiency can raise total demand because it unlocks more deployment. The market doesn't care that each device uses slightly less. The market cares that the world is building far more devices. This is the rebound effect. We get better at using silver, and then we use it everywhere. Now layer in supply. Mining doesn't respond the way people think. The popular fantasy goes like this. If price rises, miners will flood the market. That's not how it works. A mine is not a faucet. It's a decade-long construction project. It's geology, plus permits, plus energy, plus labor, plus politics. You don't summon new ounces with a higher price tag in the short term. You just reveal how tight the system already is. Fact. Mining timelines are long, and new supply can take many years to materialize. Meaning, when demand jumps or supply tightens, price becomes the shock absorber, not production. Now watch the other lever they're pulling. They're pointing to a pullback, silver sliding off highs, and framing it as profit-taking ahead of macro events. Sure, some traders take chips off the table, some funds rebalance. The market breathes. That's normal. But here's the mistake most people make. They confuse volatility with weakness. Volatility is a weapon. It's designed to shake conviction out of hands that don't understand the underlying math. If we bought silver because we thought it would go up in a straight line, we're playing a fantasy game. We're not gambling, we're measuring. So we ask, did the reason we own silver change because the price dipped? Did supply suddenly surge overnight? Did solar cancel its build-out? Did electronics stop shipping? Did strategic restrictions vanish? No. So what changed? Only the emotion. And emotion is what they sell us in headline form. Let's talk about the dollar because they love to use it as a soundtrack. Dollar stabilizes, metals pressured. Fine. In the short run, currency moves can push commodities around, but the bigger picture is the debt picture. Fact. The U.S. is running massive deficits and carrying an enormous debt load, with interest costs rising as rates stay elevated. Meaning, over the long run, systems like that tend to lean on currency debasement. Not because someone wants it, but because arithmetic demands it. If the debt is too heavy, the system searches for relief. Inflation and devaluation are relief valves. And when people lose trust in paper promises, hard assets don't average, they reprice. This is why the 5.9% story makes our blood boil. It's built for a world where the monetary system is boring. Our world isn't boring, it's stressed. Now, we need to get sharper, because this is where we either get trapped or we get paid. The trap is psychological. They hand us a comforting average. Then they flash a scary historical crash. Then they highlight a daily dip. Then they imply, be smart, take profits, don't be greedy. That script is emotional management, and it works, unless we see it. So here's the framework we use. Fact versus meaning. Fact. Silver had a massive year in 2025, and the market is now split between new bull cycle and one-time spike. Meaning, breakouts after long suppression often don't stop at the first big year. They tend to begin there because the first move wakes the market up, pulls in attention, and forces shorts and hedgers to react. Fact. Supply remains constrained and slow to respond. Meaning, that makes future demand shocks more dangerous. Fact. Strategic behavior, like export tightening, signals governments and industries treating silver as input, not ornament. Meaning, that increases the odds of competition for physical metal, not just paper exposure. And one-line disclaimer, because we manage risk, this is educational. We size positions and stay disciplined. Now let's make this practical, because theory without action is just entertainment. If Wall Street is pushing modest returns, what do? We stop letting narratives set our timeline. We focus on the only thing that matters in a physical squeeze: availability. When a market is loose, you can buy anything, anytime, and premiums are calm. When a market tightens, the paper price becomes a suggestion, and the real price shows up in inventory, delivery times, and premiums. So if we're watching silver, we don't only watch spot. We watch friction. We watch shortages. We watch who is scrambling. Because the moment industry panics, the character of the market changes. Demand turns inelastic. Buyers pay whatever they have to. That's when averages die. Now here's a question that should make us uncomfortable, in a good way. If silver is only a 5.9% asset, why do they keep talking about it? Why does it need a narrative babysitter? Nobody writes calming essays about a dead asset. They ignore dead assets. They write calming essays about assets that are waking up, because waking assets attract crowds, and crowds create risk for institutions that need time to position. So here's where we lean in. We don't chase, we don't panic, we don't worship any single day's candle. We build exposure with patience, and we respect volatility as the entry tax for a market that can snap. And we keep our eyes on the industrial heartbeat, because that's the new floor. If one sector is projected to consume a massive chunk of supply, that's not a side note, that's a regime change. Now, about those scary 70 to 90% crash stories. Could silver drop hard at some point? Yes. It's a volatile market. It always has been. But the deeper question is, if we're wrong, where will it show first? Will we see industrial demand actually fall? Will we see meaningful expansions in mining supply? Will we see policy reverse and exports flood back out? Those are measurable. Fear isn't measurable. Headlines aren't measurable. Tweets aren't measurable. So we anchor on what can be measured. And we don't let them bait us into selling our insurance because the premium moved around. Because make no mistake, silver is both a trade and a hedge. It's a trade when the cycle goes vertical. It's a hedge when the currency gets sacrificed to the debt math. Now, let's talk about positioning, because this is where people get cute and lose. Paper products are convenient. They're liquid. They're one click. But convenience has a cost, counterparty risk. In a real scramble, paper markets can change rules. They can cash settle. They can widen spreads. They can protect stability. Physical is different. Physical is blunt. If we hold the metal, we hold the option on chaos. So our approach is simple. We value what we can control. That doesn't mean everyone needs the same strategy. It means we understand what we own. Now here's the part the mainstream never says out loud. If the squeeze intensifies, the first thing that breaks isn't the price chart. It's the supply chain. Factories don't care about spot charts. They care about deliveries arriving on time. And when deliveries get shaky, procurement officers turn into predators. They sign contracts, they hoard, they pay premiums. That's when the modest return story gets obliterated by reality. So what do we do with 2026? We treat dips as tests, not verdicts. We treat volatility as the toll road to repricing. We keep our position sizing sane so we can hold through the noise. And we watch for the moment the market stops behaving like an investment and starts behaving like a rationed input, because that's the pivot. And when it happens, it won't announce itself politely. It'll look like gaps, premiums exploding, inventory vanishing, and headlines telling us it's too late. That's why the story they're selling now is so dangerous. It pushes us to exit before the squeeze announces itself. Now I want your take, because we're building this as a community, not a lecture. Do you think the real pressure in 2026 comes from industrial demand, or from a currency reset where people rush into hard assets? And if you had to pick one signal to watch, what would it be? Premiums, inventories, or policy moves? Drop your answer in the comments. It tells us what the crowd is seeing before the headlines catch up. And if you want to stay ahead of the narrative machine, hit subscribe today. Now, one last thing, because this is where they'll try to hit us next. They'll tempt us with the smart move. Take profits, wait for the dip, buy back lower. Sometimes that works, but here's the risk. In markets like silver, the biggest move often happens when nobody expects it, and it can gap through your buy zone like it wasn't even there. So if we're playing cute with our entire position, we risk getting left behind. The better game is balance. Keep core exposure and only trade around the edges if we can handle being wrong. Because the real enemy here isn't price movement, it's regret. The regret of selling a hard asset into a tightening supply story because a spreadsheet told you 5.9%. That's not risk management, that's narrative management. We don't do that. We watch the math, we watch the metal, and we prepare for the moment the market forces everyone else to wake up. Violently. When that wake up happens, the question won't be, what's the average return? The question will be, who still has silver to sell? And here's the part nobody wants to say out loud. If strategic tightening accelerates and industrial demand keeps chewing, the next surprise might not be a higher price. It might be a rule change. It might be allocation. It might be a headline that sounds impossible today, until it isn't. So keep your eyes open. Because the trap isn't that silver won't move. The trap is that they want us to believe the move already happened.